In a letter to shareholders, BlackRock CEO and chairman Larry Fink said that the war between Russia and Ukraine was the end of globalization because it upset the international order that had been in place since the Cold War and would have long-lasting effects on the global economy. The CEO and chairman of the world's biggest asset management company, responsible for $10 trillion, declared that the Russian invasion of Ukraine had ended the globalization that had been taking place for the last 3 decades. A month after Russia invaded Ukraine, the US and its Western allies started an economic war against Russia by imposing harsh sanctions that have cut off Russia's access to global financial markets. BlackRock chairman said that the battle has not only exacerbated the divisiveness and extreme conduct we're witnessing throughout society today, but it's also upended the global order that has been in place since the conclusion of the Cold War in the 1990s. Companies and governments worldwide will have to reevaluate their dependencies and reanalyze their manufacturing and assembly footprints because Russia invaded Ukraine, which Fink says has broken the ties between countries already strained by the coronavirus pandemic. Fink thinks that deglobalization would make inflation go up even more, which would make it hard for central banks to choose between higher prices and less economic activity because of the conflict. Fink said that a well-designed worldwide digital payment system would make it easier to settle international transactions while reducing the risk of money laundering and corruption. This is even though he was skeptical of cryptocurrencies after Russia invaded Ukraine. Russia's savage war on Ukraine has upended the international order that has existed since the conclusion of the Cold War more than 30 years ago, Fink said in his letter to shareholders. The global order of geopolitics, macroeconomic trends, and financial markets will be disrupted by Russia's activities, the significance of which will be felt for decades to come. Howard Marks of Oak Tree Capital, another prominent Wall Street investor, sent a letter to shareholders that shared many of the same worries. Marks warns that more sanctions would be complicated because of how much energy Europe needs from Russia. The United States needs to outsource computer chip manufacturing as Russia is cut off from the global economy. These drawbacks of globalization have forced the pendulum to swing back to local sources, as Marx put it. Supply chain shocks have driven up the cost of food, oil, and other goods due to the conflict between Russia and Ukraine. As the dispute continues, investors have fled the markets, sending the S&P 500 down by around 7%, the Dow down by over 6%, and the tech-heavy Nasdaq Composite down by 12% so far in 2022. Because of the fighting, oil and gas prices have gone through the roof. Investors are worried about inflation again, even though the Federal Reserve is getting ready to raise interest rates more quickly. The top brains at BlackRock seem worried. The world's biggest asset management company presented its 2023 global outlook this week, in which it predicted a recession, persistent inflation, and an unfriendly new period for investors. Vice Chairman Philipp Hildebrand and a group of senior executives said, "The Great Moderation, the 4-decade period of largely stable activity and inflation, is behind us. The new regime of greater macro and market volatility is playing out. A recession is foretold." Hildebrand and the company say that stocks and bonds did well during the Great Moderation, which was a time when inflation was low and the economy grew steadily. Investors will need a new adaptable approach in this new economic environment that includes the careful stock selection and more vigilant portfolio management. There aren't any long-lasting bull markets as there were in the past. Because of this, they argued for a different approach to investing in their paper. In other words, the methods that were successful in the past are obsolete today. According to BlackRock, 3 key regime drivers will make it harder for investors to earn money for years to come by keeping inflation high relative to central banks' aims, slowing economic growth, and reducing overall spending. Fewer people are available to work, and governments will have to spend more on caring for the elderly, which will lower output due to labor shortages. Based on our analysis, we believe that the current international climate is the tensest it's been since World War II, Hildebrand and his colleagues wrote. We see how geopolitical cooperation and globalization give way to a world split into rival blocs. This compromises economic viability. Last but not least, a faster transition to clean energy would eventually be inflationary unless new investments in carbon-neutral alternatives were made. They said shortages could happen if the high carbon output drops before low-carbon alternatives are brought in. This would cause prices to go up and disrupt economic activity. If the switch is made too quickly, inflation and economic activity may be more likely to go up and down. BlackRock also gave investors a breakdown of 3 themes to help them adjust to the new normal, in addition to its estimate for 2023. The asset manager specialists first claimed that next year it'd be crucial to evaluate equities while considering the damage done by central banks' interest rate rises and the likelihood of a recession. At the moment, equity values don't yet reflect the harm that will come, they said. When we look at profit projections, we discover that they've yet to factor in even a slight recession. Due to Hildebrand and the company's expectation that the Federal Reserve wouldn't rescue markets by cutting interest rates when a recession comes, developed market equities are not a favorite of BlackRock's, at least in the short run. The so-called Fed putt is now over. They suggested that investors shouldn't count on the central banks to ride to the rescue if GDP slows under the new system. Thus, buying the dip as a general strategy is inappropriate under the current administration. Hildebrand and his colleagues said that when central bankers raise interest rates quickly to fight inflation, they're deliberately making recessions. They stated, the new playbook requires a regular appraisal of how much of the economic harm being caused by central banks is in the price. The extent of the damage is growing. Even though bonds have lagged behind stocks for quite some time, they may be worth considering as a source of reliable income in light of the impending economic downturn. Fixed income provides income for the first time due to rising yields worldwide, as Hildebrand and his colleagues said. Because of this, investors who have been looking for profit for a long time but have been let down have become more interested in bond interest rates. They told investors to look elsewhere, like investment-grade credit and short-term government bonds, because debt levels and inflation were rising. Conventional wisdom says that long-term government bonds should be included because they have a long history of keeping investment portfolios safe during economic downturns. We don't believe it will happen this time, they stated. According to the Consumer Price Index, CPI, annual inflation likely peaked in June, when it was 9.1%, and some business leaders and financial experts say it's about to drop precipitously. However, BlackRock has a different approach. Even though a recession is coming, Hildebrand and his group think inflation will still be a normal part of life. While we expect inflation to decrease as consumer spending habits return to normal and energy costs level off, we anticipate it will remain above policy objectives for the foreseeable future. Given the current inflation rate, they say to stick with bonds not affected by inflation and stay away from stocks. The people who wrote the report warned that markets do not yet take into account inflation that is less predictable and lasts longer. The CEO of BlackRock predicts Latin America will benefit from the new world order. Larry Fink made some predictions about who would be best able to take advantage of the situation caused by the conflict in Ukraine after he looked at the political and economic situation around the world. Since Russia's invasion of Ukraine started more than 40 days ago, the global economy has gone through many ups and downs. This is because of the many sanctions put on Russia, the exit of several companies from that country, and Europe's decision to stop relying on Russian fossil fuels. According to Larry Fink, CEO of BlackRock Inc., BLK, all of these things have brought about a new world order. Fink remarked at the Latin American Virtual Forum 2022, hosted by the world's biggest asset management company, BlackRock, that the ongoing geopolitical strife might help those that concentrate on new enterprises, with Latin America having the potential to be one of the winning areas. Fink said that when Brazil, Mexico and Colombia opened up to international trade, there would be more nearshoring and onshoring. He said that because Mexico is close to the US, it would enormously benefit from reaching this goal. He also said that Europe would be better off if it used less energy from Russia and switched to other sources. This would change the supply chains in the area. The biggest investment manager in the world says that a new global order based on geopolitical cooperation and globalization will divide the world into competing blocks. According to the study's findings, this novel situation would encourage a persistent risk premium across asset classes, instead of having a temporary impact on markets. The BlackRock Group advises stock market investors to regularly rebalance their portfolios and seriously consider the impact of the sector, regional, and asset class circumstances. So, that was it. Remember to subscribe to this channel and press the bell icon before leaving. See you soon.